labor is probably your biggest expense on your P&L. Labor, just your technician labor alone is going to be about 26% of revenue on average. So, that's a large chunk.
Welcome to Strength in Numbers, where we share real data from over our 400 plus clients, industry trends, practical strategies you can use to grow your revenue, protect profits, and create value in your pest or lawn company. I'm Joe Brown. I'm our Director of Business Development here at PCO Bookkeepers and M&A Specialists. I'm here with PCOB's Senior Client Manager, Brian DiMarco, CPA. Brian, today's topic, what we're going to be talking about is how much should you really be spending on key categories in your pest business? Let's just jump right into it. So, Brian, last winter, really, we had hundreds of pest control business owners download the PCOB Pest Control Industry Cost Study. We published in partnership with NPMA. If you're not a part of NPMA, definitely you should join that association. In my opinion, the best association in DC. If anyone has been too busy to actually use it, and maybe it's been sitting in their inbox, how should they use it to close out 2026 strong?
Yeah, so it's a pretty cool project that we did with NPMA. There's about 250 or so of our clients within the cost study, and it really just highlights key areas and gives you the ability to benchmark you against your peers. So if you haven't looked at it yet, you could just see, all right, here are my numbers, here's the cost study, and how am I doing in these key categories to really see how you, benchmark against your peers. Where you're doing really well, where you could do better. That way you could take action, in this last half of the year.
And I mean, Brian, we hear from owners all the time, how much should I be spending on marketing, or what's a normal labor percentage? In your experience, which expense categories deserve the most attention when you're looking at it?
Yeah, so you probably hit two of them right there. Labor and marketing are going to be a huge area that an area of concern. Labor is probably your biggest expense on your P&L. Labor, just your technician labor alone is going to be about 26% of revenue on average. So, that's a large chunk. If you're unable to control your labor and how much production you guys are doing each day, that is going to give you, some issues right there. And then the other one that you've mentioned, marketing. So on average, we usually tell people 10%. I think in our cost study, it was around 12% that we saw on average for selling and advertising. Again, depending on your, growth goals, you might want to spend more, you might want to spend less, depending on, your profitability goal. But, optimizing your, whether it's pay-per-click, mailers, whatever resources you're using for your marketing, that's going to be a large percentage of revenue, and it's going to be something that you need to manage throughout the year.
When you're looking at like marketing, for example, though, I know you mentioned like 10-ish%. Does it matter? Because I've always heard that marketing really is probably the least important one to benchmark. Can you get into a little bit about like the lifetime value of a customer, how much that impacts the marketing and that sort of thing? So, because you might have a business that's 1 year old, 3 years old versus 50 years old, and how that ultimately impacts something like that when you're looking at something like the cost study when it comes to percentages.
Yeah, no, you're correct. So, 10% is a broad guideline, right? What is more important is how you're using that 10% and how effective your marketing is. If you're spending 10% and you're up, 20, 30% year to date, I'd spend that 10% all day long. But if you're spending money on marketing, you're not seeing a return, you're not seeing your client count increasing, then you're having some issues. You're going to want to get some metrics from your marketing company to see, am I getting leads in, and I'm not closing them, or maybe I'm closing all the leads that I'm getting, but I'm just not getting enough. That way you can pinpoint, the issues that you have with your marketing and make sure you're maximizing the value that you're spending.
Marketing and sales always come into play when you're talking about like the rule of 23 as well, right? Like the net income plus the revenue growth. The reason why it kind of makes sense is if you're starting a new branch and pumping everything into that selling and advertising, ultimately the net income is going to take a hit versus the growth should be going up, right? What, in your opinion, what is one expense category that surprises new PCOB clients most when we benchmark for them? And I will say, when I onboard a new client for PCOB, they always tell me they're like kind of nervous because they don't know where they're at ultimately. And I'm like, I can almost guarantee you, you're not where you think. Whether you think you're the best or you think you're the worst, you're probably not. Just from a statistical standpoint, you're probably somewhere in there, right? But which category or expense kind of surprises most PCOB clients when you're having those first real benchmark meetings with them?
Yeah, no, we definitely hear that a lot, where people are nervous to see where they're going to fall and how their numbers are going to look. A lot of our clients, when they come on, they're going based on their gut. They're not too sure where they are, and for the most part, usually their gut has been leading them the right way. But I'd say one of the biggest areas that I see that kind of creep up on people and hurt their profitability is that general and admin category. So whether it's office supplies or travel and meals or just extracurricular expenses, that can definitely creep up and be more than they suspect. Advertising is always a big one, like we touched on. And then also sometimes office staff. How many office staff do you have, there? Is it, a lot of times I see that they're overstaffed in the office, where they have too many people, and it's just not efficient, which it could also be part of their strategy. Maybe they're preparing for a large growth year and they're overstaffing their office because they have good people and they're expecting a large call volume, but that's not always the case. And that might be higher than, what they're suspecting.
Why do you think that is? That a lot of times you see overstaffed offices?
It could be inefficiency on the phones. Maybe they have some people that don't have the experience, and maybe they're just spending too much time, with each customer. Maybe they're unfamiliar with the software that they're using, and they need more training in the office. Or like I said, maybe they're preparing for a large growth year, and if you're expecting a larger volume of calls, you're gonna need more bodies in the office, right?
I think a lot of PCOs kind of have an idea, or it's talked about more like revenue per technician, right? I think what's not really talked about is revenue per office employee, right? Like at what point should you hire another CSR, right? I don't think that's talked about quite as often. So when a business feels like, we're missing calls, like everybody's at capacity, that might be the case. Or it might not be, and they're just not doing as much as they could be or should be, right? I do feel like that plays a role in it, because revenue per technician, a lot of PCOs talk about, are familiar with when you go to conferences and that sort of thing. But one thing we didn't really talk about is auto. I know it's part of cost of goods sold, which affects the gross margin, which we know is probably one of the most important metrics. But what's the benchmark there, and is that a common concern of owners? I know when you get into taxes, everybody talks about, I'm just gonna buy a truck, that kind of thing. But like, how does it impact it, right?
Yeah. So from our cost study, we found out that your auto percentage, as a percentage of revenue, should be about 6%. And it is, in your cost of goods sold. So if you think back to your cost of goods sold, it's everything that happens on the road to get the job done. If, your technician needs a truck to get the job done, right? They're running a route. So the fuel it takes to go to every stop, the maintenance to keep that truck up and running, the insurance to have that truck on the road, that's all a part of the cost, essentially, to get the job done. So we're looking for 6%, right around there. 2 to 3% of that might be fuel. The rest is going to come from maintenance and also insurance. Depending on your location, your insurance might be higher than others. I hear a lot of clients complaining about that lately. Their insurance costs keep going up. But you brought up a good point too. As far as taxes, you can get a new truck, take accelerated depreciation to lower your tax benefit as low as possible. But you want to be careful about the timing of when you buy trucks. You want to keep an eye on that maintenance ledger, how much you're spending on maintenance and how much a payment would be for a new truck. and see that cost benefit kind of time out when you're going to purchase the truck.
Why is that? Is that coming from like a cash flow standpoint?
Yeah, absolutely. Because just the values of these new trucks that people are buying, the interest rates, payment could be anywhere from $700 to $1,000 a month, depending on the truck you're buying, right? If you have an older truck, just because it's up in miles, if you're not having, large repairs, engines, transmissions, things like that, it might be better for you to keep that truck in service, keep up on the routine maintenance, then go ahead and just replace a truck, right? Because it's different from buying a new truck to add a new route and replace a truck that's already in service. If you're adding customers and you need a new truck to build a new route, go ahead and purchase that. But if your truck has a warranty, if you're able to do routine maintenance, you want to extend that lifespan on that truck as long as possible. It's going to help your cash flow.
When it comes to vehicles, right? Do you, and I don't know if you recommend one or the other, when it comes to leasing versus purchasing, the different types of leases, right? I think depending on, and you know better than me when it comes to this, but depending on the way that you purchase the vehicle, it's either on the P&L or on the balance sheet or both. There's something like that. Can you explain that to me a little bit? And is there one that you see most people do and why?
Yeah, no, you're absolutely right. So there's two types of leases. It's either an operating lease or a capital lease. If it's an operating lease, you're going to have your auto lease expense right on your P&L, meaning you're not going to have your vehicle listed on your balance sheet or your depreciation schedule on your tax return. The other one is a capital lease. Most people are utilizing that, meaning you're actually purchasing the vehicle. You own it outright. You could take accelerated forms of depreciation, which can help you, to lower your tax liability. A lot of the times too, I know some of our clients do use Enterprise or some of these other, leasing agencies. Just because it says it's a lease, you always want to double check with them and ask them, is this an operating lease or a capital lease? And if you're looking for the depreciation for taxes, you can usually ask them to write up the deal for it to be a capital lease. That way you could take that, bonus depreciation or Section 179. That could definitely help out with any tax liability that you may have.
That would suck if you go buy a vehicle thinking you're going to depreciate it and all of a sudden you got the wrong lease.
Yeah, no, it definitely happens.
Anyway, if someone finishes this episode, right, what's one action item that you'd encourage them to take this week, right? Maybe they watched the whole thing, maybe they saw a little short of it, right? But what's one thing that somebody could take from this that you'd encourage them to do this week?
Yeah, first off, if you haven't already, go out and get our cost study. Go ahead and review that. Take out your own numbers, salute your P&L side by side with the cost study, and just see if how you're doing. See if there's any areas that you're struggling in. If you can't make sense of your financials, side by side with the cost study, maybe give Joe a call and get set up with us so we could help you out. But definitely dive into the cost study, review the numbers, see where you should be, see how the industry is doing, and then make a plan for action. What areas can you improve upon, and try to make the second half of this year worthwhile.
And the cost study is great because it shows all the averages. I do know, as you know, like every quarter our clients are getting the averages of everybody anonymously, and then they're also getting what percentile they're actually ranking in, right? Because depending on the category, you might just want to be average, but then when it comes to something like if you're in growth mode, you might want to be in the top 5-10%. So every quarter I know our clients are getting their ranking and their percentile as well, so that they're not just comparing the averages. They might want to be above that or below that in certain categories. So I appreciate the time, Brian, and as always, it was a pleasure talking with you, and thanks for joining Strength in Numbers.
Yeah, thanks for having me. Pleasure.